and welcome to the lecture. So students, as we know that we are covering the financial system and basically we are discussing over the Reserve Bank of India. Alright, in the last lecture we had discussed some facts and figures about it, and basically these were the topics which we had scheduled for the completion. Okay, so far we had done with the introduction part, then we had done with the monetary authority. In the previous lecture we had started the discussion over the banker to the government. Okay, and these are the topics we are left with: banker's bank, forex custodian, regulator and the supervisor, monetary policy, and the forex management. Okay, so these are the topics which are left. So right now we will begin with the banker to the government because we had left it in the previous lecture in the midway. So first we will complete it, then we will move to the next lectures. So monetization of debt we had completed in the last lecture. Right now we have the custodian of the cash reserves. Okay, custodian of the cash reserves, what do you mean by it? The RBI also act as the custodian of the government's cash reserve. It holds and manages these reserves to ensure the liquidity for the government's financial operations. Okay, so basically you can say, for example, suppose this is the government. Okay, government, or you can say more precisely it is the Ministry of Finance. Got it? This is an Reserve Bank of India. Alright. Thereafter, what we had seen in the previous lecture, they are responsible for the fiscal policy. They are responsible for the monetary policy. These two things we had just seen in the previous lecture. Now it is the entire picture. Alright, fiscal policy deals with the expenditure and the revenue. Monetary policies deal with the cash flow. So you can say, for example, by the mutual coordination, they both had decided that at least currency of worth rupees 20,000 crores should be in the circulation of the economy. They had decided this particular fact. Got it? But what do you think? If this has been decided, only this amount will be printed? No. There always be an amount in the excess which we call as a buffer zone. Okay? A buffer cash reserve you can also call it. Okay? For example, 20,000 crores is a decided currency flow, but at least some excess, for example up to rupees 5,000 crores are in the buffer cash reserve. Got it? What do you mean by it, buffer cash reserve? What is the meaning of it? So you can say here, you could also see that holds and manages these reserves to ensure the liquidity for the government financial insurance or the financial operations. Maybe in the upcoming time, or you can say in the current situation also, some cases arises in which the government required the more money. Okay, or you can say not the government but the economy requires the more infusion of the cash. What will happen in such a situation? In such a situation, money will be withdrawn from these cash reserves. Okay, it means that this rupees 5,000 crores will be infused to the economy on the immediate basis. Okay, but until or unless there is no requirement of it, this amount will be preserved and you can say will be in the custody of the Reserve Bank of India. So that's why we called it as a custodian of the cash reserves. Got it? I hope now you have got it. Alright. So after finishing the introduction, the monetary authority and the bankers to the government, now we have the banker's bank. Okay, what do you mean by it? If we look at the RBI Act 1934, okay, which leads to the formation of the Reserve Bank of India, in 1935. Got it? We had just seen it in the previous lectures also. This is the case. Why? Because there is another year also which is called as a 1949. What happened in the 1949? Basically, that was a time period when the Banking Regulation Act 1949 was passed. Okay, Banking Regulation Act 1949 was passed in the 1949, and this made the RBI an apex institution for handling the banking and financial institutions. Got it? So that's why this ultimately made the RBI as the bankers of the bank. It means that RBI now having the full control on three type of institutions we called as a financial institutions. Second one are known as the non-banking financial corporation. Okay, and thereafter the banking institutions. Okay, as the powers are granted by Banking Regulation Act 1949. Got it? So now I hope you have got an overview of the things. Okay, so let's move ahead. So basically, if we take an overview, as the bankers bank and lender of the last resort, the Reserve Bank of India plays a critical role in supporting the banking system. All right, basically the 1949 Act not only made the Reserve Bank of India as the regulator only, but also as the supporter. Okay, now they had got a two prime tasks. First, to regulate the banking. Second is to support the banking system. How? We will see in this particular series. So let's start with the introduction. RBI act as a bankers to the other banks, providing them with the various banking services. Okay, includes holding their cash reserves, providing funds for the clear transactions, and acting as a settlement agent in the interbank transactions. Banks can also borrow from the RBI in times of need using eligible securities as collateral. Okay, so here we just had seen an overview, or you can say the basic introduction. All right, however, we will you can say discuss these points in a proper manner, but here is one thing which I would like to tell you before go further, which is known as the interbank transactions. What is the meaning of this particular term, interbank transactions? Okay, for example, you can say, suppose this is bank A, this is bank B, all right, this is bank C. Okay, now due to some reasons, these banks require the interconnected transactions. Okay, so now the question is, who will do this? So this is the first chart I have made for you. Like, these banks personally contact each other, then made the payments and all, but this could lead to the chaos. Why? Because there is no intermediary in between to ensure the fairness and authenticity. Maybe the transactions which have been done between these banks illegal or whatever you can say. Okay, so to counter this kind of situation, what generally happens, the Reserve Bank of India, or you can say these are the bank A, B and C. Okay, so whatever transaction they are required to do with each other, they have to intimate the same with Reserve Bank of India. Okay, then the Reserve Bank of India will clear the transaction on behalf of them and make sure the right transaction should reach the right place. Okay, so instead of this particular picture, okay, we generally have this picture which is crystal clear. Alright, so that's how the Reserve Bank of India ensures the interbank transactions. Okay, banks can also borrow from the RBI in times of need using eligible securities as a collateral. What do you mean by it? We will see in this lecture. Okay, so the first is lender of the last resort. In times of financial distress or the crisis, when the banks are unable to meet their obligations and there is a risk of systematic failure, the RBI acts as a lender of the last resort. Provides emergency funds to bank to prevent them from collapsing. This support is crucial in maintaining the stability in the financial system and preventing panic withdrawals by depositors. Okay, now this is the thing. In the insolvency and thereafter in the bankruptcy case, in the insolvency and the bankruptcy case, I had told you that when an organization, suppose the XYZ, is getting the condition in which its assets are lower than its liabilities, then they become the insolvent. Alright, similar thing could be happen with the banks also. Why? If we talk about the liabilities, then liabilities are basically the deposits the bank held. Okay, because it does not belong to the bank, it's belong to the depositors who had deposited their money with the bank. Whereas if we talk about the assets, assets will be loans which have been granted, and second is the investments which had made by the banks in various entities. Alright, so there are the chances of being defaulted. Okay, what if the loans become NPA, non-performing assets? If the investments were not generating as they were expected to be, if any this kind of situation arises, then this is known as the financial distress, or also known as the financial crisis. So to counter this kind of situation or to manage this kind of situation, what generally happens, the banks try to arrange the money either by external borrowings, okay, or you can say through the secondary capital uses. Okay, so there are two kind of situations. All right, but in the meanwhile, what generally happens, the deposits could be withdrawn by the people who had submitted their deposit with the bank. All right, so the financial stability of the bank could be more and more damaged. All right, so basically this thing is generally ensured by the Reserve Bank of India, or you can say when the bank is unable to arrange the money to meet up its financial obligations towards the investors, towards the depositors. In such a scenario, the Reserve Bank of India will come in the picture and then grant a loan. For example, you can say if the assets are of rupees 200 crores, liabilities are of rupees 300 crores. Okay, so in such a case, liabilities are higher than assets. So to counter the situation, what will happen? ₹100 crores will be provided by the Reserve Bank of India. Okay, so that the bank could balance the situation and then could continue its function as normal. Alright, so that's why it is known as the lender of the last resort. Okay, so it could reduce the risk of systematic failure. Remember, always remember, whenever the banks collapse, then it is an huge loss for economy. Why? Because first of all, the financial and the credit source was damaged. Second reason is the depositors who had deposited their amount in that particular bank will get lost their amounts. Alright, and this could damage the financial stability of the individuals also. Got it? Thereafter, another thing we have is refinance and the short-term loans. RBI provides refinance facilities and short-term loans to the banks to help them manage their liquidity needs. However, about refinance we had already discussed in the previous lectures, but here also I will make sure that you will get the meaning of it. This is especially important during the times of tight liquidity in the financial markets. Okay, so let's revise the refinance. Suppose this is a bank called the XYZ. Okay, it has provided 100 crores as an loan. Okay, so remember, loans are always provided for the specific time period. A specific time period. It means the amount which had been provided as a loan will be returned to the bank after a certain period of time. Got it? So you can say, suppose if the total deposits held by the XYZ were 300 crores. Out of 300 crores, the 200 crores has been granted as a loan. So right now they are left with only rupees 200 crores. Okay, and for example, this 200 crores is not in accordance that the bank could maintain its NDTL, or you can say net demand time liability. Net demand time liability. It is called as NDTL. Okay, so in such a scenario, what will happen? The Reserve Bank of India, will provide this 100 crores to the XYZ, and this particular term is known as the refinance. Why? So that the bank could carry out effectively and smoothly and could discharge its net demand and a time liability. Okay, so this is a case of refinance. Okay, and short-term loans also we call it for some time. Why? Because after some time the XYZ is required to repay the 1,000 crores to the RBI bank. Okay, thereafter we have the maintaining the financial stability. What do you mean by it? Let's see. By acting as a lender of the last resort, RBI helps maintain stability in the banking system. As we had just seen, if anything happen, it means that if the bank collapsed just because of the situation, when the assets are lower than the liabilities, just because of this situation, if the bank collapses, what will happen? The financial stability in the banking system will be affected. Okay, so the RBI protects it, prevents the spread of financial crisis, and ensures that the banks can continue to function smoothly. Okay, thereafter the regulatory oversight. As a part of its role as a lender of the last resort, the RBI also exercises regulatory oversight over banks, set prudential norms and guidelines to ensure that the banks maintain adequate liquidity and manage their risk effectively. Okay, as we had seen in the previous lectures already, like you can say, for example, if this is a particular bank, XYZ, okay, and the XYZ is containing rupees 100 crores. So they have to deduct the CRR, which is known as the cash reserve ratio, okay, thereafter the statutory liquidity ratio, all right, thereafter some other kinds of obligations, all right. So for example, you can say the cash reserve ratio is 10 crores, or you can say 20 crores. Statutory liquidity ratio is about for 10 crores. Okay, so 30 minus 100, how much will be left? 70 crores will be left. Got it? So this 70 crores is now available with the bank to grant as an loan. All right. And as we had seen, no one is more greedy than the bank. Okay, if this is a situation, no one is more greedy than the bank. So what will happen? The bank will try to lend out more and more and more amount to the borrowers. Why? Because the more amount they will lend out, the more interest they will receive as their income. Okay, but what happened? The bank should maintain an adequate supply to maintain the net demand and time liability. Okay, because the depositors who had deposited their money with the bank maybe come to withdraw their amount. All right, and this amount the bank holds, it basically comes from the bank's own capital plus deposits. Okay, and as we had discussed in the previous slide also, that the loans which had been granted by the banks are basically time bound. There is a specific time period for the returning of that particular loan. Okay, so go by this definition. What will happen? Suppose if the 70 crores has been granted as a loan, so the bank is defaulted at its NDTL and the net demand and time liability. Okay, so to counter this kind of situation, because right now the assets are lower than the liabilities, okay, so to counter this kind of situation, what will happen? The RBI will provide the loan or amount as a lender of last resort, so that the XYZ could ensure the meet up to the NDTL, or we call it net demand and time liability. But what will happen? The RBI will check out the lending process, like why the amount was lent out, what was the reason and procedure. Okay, so that they could ensure the prudential norms and the guidelines. Okay, these guidelines and norms decides that how much the bank should lend out. Okay, so that the bank could maintain the adequate liquidity and manage their risk effectively to counter any situations like this one. All right. So students, basically this is the topic of bankers bank and the bankers to the coming. So in this lecture, we had discussed the bankers bank. In the next lecture, we will start with the forex custodian and other topics. Till then, just revise all the facts and figures we had discussed in this lecture. Be ready for the another lecture. With this note, let's end this lecture, and what we say thank you.